Welcome back to the Deep Dive. Today we're digging into MillerKnoll, that's ticker MLLKN, and their latest numbers from the Q1 fiscal 2026 earnings call. A big name in office and home stuff.
Yeah, and it's an interesting one because on the surface, Q1 looked really good. Solid beats on profit, on sales, just clean execution,
Right.
But the market kind of shrugged. The stock didn't really pop and hold. So that's what we need to unpack, why the solid results didn't quite light a fire under investors. What's going on with the outlook?
Okay, let's start with those good numbers, the wins, because they weren't small. Adjusted EPS, 45 cents. The street was looking for maybe 35 cents.
Exactly. A really significant beat there. And revenue followed right along, came in at $955.7 million.
Against consensus expectations of, what, 9-11 million?
Yeah, comfortably beat that. And almost 11% growth year over year. Pretty strong top line. But the real story, I think, is often in the margins.
Agreed. So tell me about those. Gross margin hit 38.5%. But, I mean, they still had that tariff stuff hanging over them, right?
Yeah.
Had an $8 million hit.
They did. And that's precisely why the margin story is so positive here. Despite swallowing that $8 million net impact from tariffs, their operating margin expanded significantly.
How much?
5.6% on a reported basis, 6.3% adjusted. Compare that to just 1.8% last year.
Wow.
So it really demonstrates credible execution. They're managing costs, getting leverage. Even with those external pressures, the operations team seems to be firing on all cylinders.
So where did that strength actually come from? Which parts of the business are really driving things?
It's overwhelmingly the contract segment. That's the big office furniture side of things.
Okay.
North America contract sales jumped over 12% year over year. And international contract, even stronger, up over 14%.
So that return to office trend, or maybe just office refresh trend, is finally showing up in their numbers in a big way.
It really seems to be. That cyclical rebound is definitely hitting the income statement now.
And the other side, global retail. How's the consumer holding up?
It grew too, 6.4% globally. North America retail orders were up 5%. And interestingly, web traffic saw a pretty healthy 17% jump.
Okay. So consumers are still browsing, still interested, even if maybe not pulling the trigger quite as fast as businesses.
Seems that way. Retail is contributing, but contract is clearly the main engine right now.
All right, now we have to tackle the elephant in the room for some investors, the order numbers. Consolidated new orders were down 5.4%. How does that square with sales being up nearly 11%?
Yeah, that's the key piece of context here, and management was quite upfront about it. They called it order normalization.
Meaning?
Meaning they saw a huge chunk of orders pulled forward into the previous quarter, Q4 of fiscal 25. Customers rushed orders in before pre-announced tariff surcharges and price hikes took effect.
Okay. So basically, they stole sales from their own Q1. How much we're talking about?
Management put a number on it. Somewhere between $55 and $60 million worth of orders landed in Q4 that likely would have otherwise been Q1 orders.
Got it. So if you smooth that out, if you look at Q4 and Q1 together, what does demand really look like?
Much healthier. For North America contracts specifically, if you combine those two quarters to normalize for that pull-ahead noise, the underlying order growth was actually positive 3.3%.
Okay, so steady. Not accelerating maybe, but definitely not collapsing like that negative 5% headline figure might suggest on its own.
Exactly. It paints a picture of stable underlying demand in their core market.
And while operations were strong, they also made a move on the financial side, right? Dealt with some debt.
They did, yeah. Smart move. They refinanced their big term loan B, pushing the maturity way out to 2032.
Gives them breathing room.
A lot of breathing room, long-term stability. Now, it did trigger a $7.8 million non-cash charge for debt extinguishment, basically accounting for the refinancing costs. But non-cash is the key there.
Right, not cash out the door.
Correct. And their overall debt level remains pretty comfortable. Net debt to EBITDA is under 3 times at 2.92. So solid financial footing.
Which is important because that footing lets them fund the things that, well, probably made that Q2 guidance seem a bit underwhelming to the market. Let's pivot to that outlook.
Right, the guidance. It was definitely on the cautious side. Revenue for Q2 guided between $926 and $966 million, and adjusted EPS between 38 and 44 cents, which, is sequentially down from Q1's 45 cents.
So management's explanation for that? They pointed to the first half overall, right?
Yeah, they framed it by saying, look, if you take the Q1 actuals and the midpoint of this Q2 guide, first half sales growth works out to about 3.8%.
Which ties back to that normalized growth rate we just talked about, stripping out the Q4 pull ahead.
Exactly. So they're essentially signaling stable underlying demand, consistent with that normalized view, but not some major acceleration yet.
And there are specific costs hitting Q2 hard, right? Two big ones.
Two main drags baked into that Q2 guide. First, tariffs are still biting. They expect another $2 to $4 million pre-tax net impact in Q2.
Still, I thought they were working on mitigating that.
They are, and this is a huge point for investors. Management sounds very confident they'll fully offset these tariff costs in the second half of the fiscal year.
Confident how? Did they lay out the plan? What gives them that confidence?
Their argument is based on timing. They've already put pricing actions into the market to counteract the tariffs, but there's a lag, maybe 2 quarters, before those price increases fully flow through the P&L.
So the actions are taken, the benefit just hasn't hit the bottom line yet.
That's the narrative. They expect Q3 and Q4 to see the positive impact, getting them back to basically zero net tariff drag in the second half. But, the market wants to see it happen first. It's a show me story on tariffs.
Okay, so that's cost number one hitting Q2. What's the second?
This one's a strategic choice. They are spending heavily on expanding their retail footprint.
The new stores.
Yeah, big time. They're planning to open 12 to 15 new stores in the U.S. this fiscal year. That's aiming to more than double their current footprint.
Aggressive and expensive upfront.
Very. It comes with significant pre-opening costs and then higher operating expenses as those stores ramp up. They already took a $3 million hit in Q1 for this.
And Q2.
They flagged an incremental $4 to $5 million in operating expenses related to this retail expansion hitting in Q2.
Ouch. So that explains a lot about the Q2 margin pressure. And it explains why the retail segment's adjusted operating margin in Q1 looked so low, only 1.2%.
Precisely. They are deliberately choosing to invest heavily now, sacrificing near-term retail margin for what they believe will be long-term market share gains and growth.
It's a bet. And are they backing that bet with product?
They are. That's another key part of the strategy. They're launching 50% more new products this year compared to last year, a significant acceleration.
And is that working?
Early signs are good. They said orders for those new products are already showing over 20% growth, so the innovation pipeline seems to be resonating.
We also saw some leadership shuffles. Jeff Stutz moving up to COO, overseeing international and operations. Feels like tightening the screws post-Knoll integration.
I think that's right. It signals a shift from managing the merger complexity to really focusing on efficient, brand-led growth, connecting that design innovation straight through to delivery, getting leaner, faster.
Okay, so let's tie this all together for the listener. Stock was weak coming in, general macro worries about cyclicals, Q1 itself, a clean beat, good execution.
Yep.
But the Q2 guidance, way down by those guaranteed, costs the tail end of tariffs, and especially those big retail store opening expenses that kept investors cautious. Is that a fair summary?
That's exactly the dynamic. Strong execution internally, but the near-term cost headwinds in the guidance dominated the narrative and the market reaction.
So what are the key things investors need to see now? What are the catalysts to change that cautiously constructive view?
3 main things, I'd say. First, you need proof that the strong funnel in the contract segment converts into actual large project wins, show that the office rebound has legs.
Okay.
Second, deliver on that H2 tariff promise. Show the mitigation is working and the net impact goes to 0, like they said.
Prove it.
Yeah, prove it. And third, start showing some real productivity ramp from those new retail stores in Q3, Q4.
Yeah.
Demonstrate that the investment is starting to pay off, even if it takes time.
Until those happen, the stock might just tread water.
That feels like the base case right now, yes.
All right. This setup, the known costs now versus the hoped-for benefits later, is perfect for our This Is Not Financial Advice segment. Remember, everyone, this is purely a thought experiment, educational. What's an outrageous but plausible trade idea springing from this report?
Okay, so the core idea hinges on that timing mismatch we just discussed. All the bad news, or at least the guaranteed costs, are front-loaded in Q2. The potential good news tariff offset store ramp-up is backloaded into the second half and beyond.
Right.
So an outrageous but plausible trade might try to exploit that. Maybe something like a calendarized call spread on MLKN.
Okay, break that down. What's the actual bet you're making there in simple terms?
You're essentially betting against the near-term drag and on the longer-term recovery. So you might sell shorter-dated call options, ones expiring around Q2 or Q3, when the stock price might still be weighed down by those known store costs and tariff remnants.
Capturing some premium while the outlook is murky.
Exactly. And then simultaneously, you buy longer dated call options, maybe expiring way out in fiscal 27. You're betting that by then, the tariff issue is gone. Those 12, 15 new stores are contributing positively to high margin revenue, fueled by all those new products.
And the market finally recognizes the improved earnings power, leading to a potential re-rating of the stock multiple.
That's the bet. It's a play on management executing the H2 tariff fix and the retail strategy, successfully transitioning from a margin drag today to a significant growth driver tomorrow, post-integration.
A timing bet, essentially.
Yeah.
Fascinating. Requires patience and conviction that management delivers.
Definitely not a short-term trade.
Okay, let's wrap this up. Key takeaways for you, the listener. MillerKnoll showed strong Q1 execution, proving they can manage costs. But the market's focus is squarely on the near-term headwinds hitting Q2 guidance, getting those tariffs fully offset and absorbing the significant costs of doubling their retail store count this year.
Yeah, and it leaves us with a really important question, doesn't it? We saw that underlying demand in the core contract business looks pretty resilient, that normalized 3.3% growth. Is that underlying cyclical strength now powerful enough to carry the company through this period of heavy but necessary investment spending?
Will the rebound outweigh the cost?
That's the question that's likely going to define how this stock trades for the rest of the fiscal year.
Definitely something to watch. Thanks for joining us on this deep dive. We encourage you, as always, to dig into the source material yourself.